Experts say there is a ticking time bomb coming for many Americans' retirement nest eggs, but there's still plenty of time to defuse it before it wreaks havoc on the country's retirement savings. The time bomb is in the form of the huge tax bill many savers will owe when they start taking distributions from widely used tax-deferred retirement accounts like 401ks and traditional IRAs. And according to IRA expert Ed Slott, that bill is only likely to increase. As it stands, those who invest in a 401k or traditional IRA don't pay taxes on the contributions, but that means that the bill will come due in retirement when they withdraw funds. Because of this, the amount displayed on account statements is far higher than what people will actually be able to spend on living expenses, says Slott. And many people don't understand just how much they could owe. Slott explained, "None of these accounts have been taxed. That's the deal we made with the government. We get a tax deduction, but we'll pay for it later. The IRA is an IOU to the IRS." And thanks to a soaring stock market, sizable inheritances, and a growing emphasis on investing early, Americans have an astounding amount of wealth tied up in these accounts. In the first quarter of 2024, Americans had $7.8 trillion invested in 401ks and $14.3 trillion in IRAs, according to the Investment Company Institute, meaning retirement savers owe trillions in taxes. While many people are focused on how they should be saving now, Slott says more need to start accounting for their tax bill in retirement. One way to defuse the bomb? A Roth IRA conversion. Savers will pay taxes now, but Slott says that's better than waiting with tax rates being on sale right now. Although the federal rate maxes out at 37%, many will pay rates as low as 10 or 12%. We're at the lowest historical rates many of us are likely to ever see, says Slott. You don't realize how good you have it now. These are the good old days. When you convert a traditional IRA to a Roth IRA, you pay the taxes at the time of conversion. Slott says that while no one likes to pay taxes up front, it's never made more sense to do so. In over 40 years, he's never had a client regret a Roth conversion. As long as you're paying the tax, it will grow for the rest of your life income tax-free, he says. Potential tax law changes make today's rates look doubly good. While many people expect to fall into a lower tax bracket in retirement, that isn't always the case. Slott calls the belief you will be in a lower tax bracket the #1 retirement myth. And depending on the outcome of this year's presidential election, people may see their tax burden increase if the individual tax cuts from Donald Trump and the Republicans' 2017 Tax Cuts and Jobs Act expires after 2025. Slott also points to the country's current debt level, which sits at more than $35 trillion, as another reason he believes tax rates will increase. He argues that the last thing many people want is their retirement savings subjected to the uncertainty of what tax rates could be in the future. Either Congress is going to keep kicking the can down the road, or they'll have to raise taxes, he says. And the people at the highest risk of getting hit with those taxes are the ones with the most money in these tax-deferred vehicles. Other planning options include charitable giving and purchasing life insurance. Whatever planning savers decide to do now, it's better than standing idly by and getting a surprise in retirement, he says. There's an opportunity now to get that money out, says Slott. After next year, rates are supposed to go up again, so you still have around 2 years at the rock bottom tax rates.